Entrepreneurship, Chapter 13, Financing for Startups. What is equity financing? So we're going to be talking about getting these businesses up and running. How do you raise capital and how you bring in money to get them going? And so we're going to start with the sale of shares of cash. And this is where you basically sell shares of your business to other individuals to who gain equity in your business to try as a way to get capital. Uh, One of the things we can tell you is when you start this business initially, because you don't have any income, any revenue, you want to try to avoid investments at first because basically, people are investing in something, or I should say people will try to avoid it first because investments, can be long and risky and you haven't started anything yet. So that could be something that causes people to stay away. Some businesses are more capital intensive. Basically, depending on what type of business you get into will determine how much capital you will need. And I'll give you an example. If you have something that basically has low overhead and low inventory because you're providing a service versus somebody who's actually has higher overhead and actually has to buy equipment to manufacture something. So there's going to be different from different types of businesses. So splitting the ownership pie. So when you think in terms of when you start an entrepreneur endeavor, your ownership, you have 100% of the pie. It's yours when you have it and no one else is investing in it and you own it all. But as you see, at some point to raise money, you may need to sell equity and stuff. Your slice of the pie may get smaller, but the pie may get larger. So when you look in terms of that, you think that, okay, well, I don't own 100% of the pie anymore, but the pie's got much bigger. So my percentage has actually gotten bigger than what it was before. And you think in terms of splitting the pie, you start before the investment. Can be tricky because of you're splitting what doesn't really exist. So again, it's kind of like you're selling pie in the sky, or your vision or your dream. Stages of equity financing. So we got seed stage. This is when you're trying to get money to get something started, up and running. You have the idea and you're trying to get it up and running. Startup is when you got the money provided for entrepreneurs to enable them to implement an idea that they have funding their project. Early stage financing is when you look at, you're up and running and you're doing something, but you need to try to take it to the next stage. So when you look at these different stages of equity financing, seeking second stage or late stage financing, this is when the business has been going for a while, but now you're actually seeking additional money to bring in because you need to grow. And so you're trying to take it to the next level, so you're seeking this additional funding for that. Another way to generate some money is to have a public IPO, initial public offering. That's what IPO stands for. So selling stock. That's another way to bring in money, selling shares of your stock, of your company. Now, you have to be careful when you do that because you don't want to sell too much. You want to make sure that you maintain at least 51% so that you're still the majority owner. And bridge financing is when you are actually looking to finance. Entrepreneurs may need financing to cover expenses associated with the with the IPO. So stages of equity financing. So we got the 3 F's. That's friends, families, and fools. We talked about that in the previous chapter. How you can earn money or raise some money through that way. And then you have angel investors. Those are people who they have their own money and and would be willing to help finance a young startup. Then you have venture capitalists. These are business people who are profit oriented. They're willing to give you money for interest in your business. And the difference between the angels and the venture capitalists, the angels are somebody a lot of times could be somebody who's just really trying to help you get up on your feet. The venture capitalists are in it for a profit. And they are, we're going to talk a little bit more about some of that, how they may get involved in your business. Know the value of your company. Know the value of your company. When you're trying to evaluate your company and talk to people before you get up and running, know How much is your company worth? How much product can you sell? What is the profit margin? All these things you need to know. Know the value of your company. When you're talking to these entrepreneurs or these potential investors, venture capitalists and others, these people are going to try to negotiate with you based on what they determine to be the value of your business. And a lot of times they will try to lowball you. So you have to know the value of your business. How can entrepreneurs value their companies? Very few overnight successes. When you look at most entrepreneurs and they have success stories, you only hear about the success stories. You didn't hear about a lot of times about how they got there. A lot of times the setbacks and the failures and all the other things, or how many years it took them to do this. So it's not something that you want to say that you're going to be doing and starting overnight. Entrepreneurs, they usually value their companies based on the firm's potential in the chosen market. The easiest way to do that is look at similar industries. True valuation between owners and investors. Again, understanding what the value is, these investors will try to do a valuation of your business, and you'll have to do one. And trust me, they're always going to try to value it lower than what you will. How do investors value startups? Better position your company. Knowing the criteria matters a lot to them. You can better position your company to attract investors if you have experienced team members, you have industry experience, and you have professionals working in that organization. And that's going to let them think that, you've assembled a team that's going to give them a better chance for success, a better rate of return for them. Pre-money valuation is the company's value before it receives any investment money. Post-money evaluation is after it receives its first round of investment money. The age of the unicorn. Once upon a time, the valuation of the unicorn used to be considered a tech industry where it was valued at least $1 billion startup. A tech company's valued startup at $1 billion. And that was really rare. What we're beginning to see now, rare becoming more common. We're seeing more and more companies who are actually meeting that threshold now. And some of them are not even tech companies. Convertible debt, short-term loan turned into equity. So when you look at that, you can look at debt converts to stock shares, benefits and advantages. So when we look at short-term loans turned into equity, so you can look at borrowed money from a financial institution, and it can be a short-term loan that ultimately can turn into equity for you based upon the level of income that you've got coming in. Debt converts to stock shares. So after this, initial debt converts to stock shares after agreed certain point in time. At some point in time, the debt will convert to stock shares. So you see how somebody's actually gaining interest into your business that way. So if you look at the benefits and advantages, valuation becomes easier at the point around the financing when there is more data and information to work with. If the discount is too low, investors may not commit. And if it's too high, the investor may take into account when pricing the stock. So when you're looking at this, you got to take in terms of, you can't be too low or too high because you come with problems either way when we do that. And cautions and disadvantages. When you talk about young startup business, whatever, early lenders may not want to take that risk of having money debt associated with a startup business, and it may scare some people away. Angel investors. So let's talk about angel investors historically. Angel investors historically meant wealthy investors who invested in Broadway theater shows. Now it's kind of evolved a little bit, so anybody can be considered an angel investor who invests their own personal money. But now, let me tell you about these folks. These are wealthy people. In order to be an angel investor, you have to have earn a minimum of $200,000 a year, or a net value of about $1 million a year. And so bringing experienced people into your organization like that, with that kind of financial clout, can add a significant value to your organization. Finding an angel investor. So you can go to an angel list to find folks that may be interested in doing investing into your business. Sometimes you can find people through referrals to various people. So tap into your own network to see if you can find angel investors and people that you may know, may not know. Just talking to folks can provide you referrals to help you find these types of investors. And believe it or not, there are more of them out there than what you would think, particularly if you're out there in the market looking for them. They're not hiding. They're definitely out there because they don't make money hiding. They make money by being found and finding good opportunities. So you have types of angel investors. You have the entrepreneur angels, people who are looking, who own businesses themselves. And you have corporate angels. These are people who are big corporate people, and they work in corporate America. So they're usually former business executives and people like that. You have professional angels. These are people who are like doctors and lawyers, accountants, or self-made people. And then you have enthusiast angels. These are people who are like retired executives, and they have personal wealth and they're willing to invest. Angel groups. So when you look at angel groups, you find this is they pool funds to invest and work together to conduct due diligence and work together. They meet regularly to hear pitches. So these groups, this is kind of like a business endeavor for them. It's an investment endeavor, but it's a business endeavor for them. And they tend to specialize into types of industries that they have expertise in or familiarity with. Give you an example. If you take a guy who's retired from the tech industry, well, he's an angel investor now. He was a CEO. Now he's an angel investor, but his thing is he looks for tech companies, startup tech companies. Now, there's some things about this when you always say men and women, we are the same, but we're different too. One of the things that comes in the research has shown that women are better investors because women have a tendency to take their time and do more research than men. So when you look at that, it's just like, wow. Sometimes you might pay to listen to a female advice on that, particularly if you're doing your own research. You check your information against hers. Few angels from marginalized backgrounds. So when you look for marginalized backgrounds, whether it be ethnic groups, racial groups, or whatever it may be, you find a few angels from those backgrounds and stuff. By virtue is, if you look at like discrimination and oppression and things like that that's held people back, because you look at a lot of people who are in the angels, a lot of them have generational wealth. And that's what you won't find with marginalized people with backgrounds. You can find minorities and people, women with different ethnic groups with money, but it's not generational wealth. So milestones for angel investment. So when you look at the milestones for angel investment, they're usually looking for something that they're invested in that it's going to usually last about 10 years or so. And they're looking for revenue to bring them in for as much as, when you talk about growing something rapidly, about 10 million in revenue. When we look at the venture capitalists, we see mostly professional money managers. So you see people who are actually already in the industry. These people are looking for return on investment. This is business to them. They earn through equity in different companies. So as you see, these people will have monies invested in multiple organizations and multiple startup entrepreneur endeavors. So one of the reasons you do that is to try to minimize losses. Let's say if you got your money spread into about 5 different businesses and 2 of them take a dip, but 3 of them are up. So that means you have a net up in making money and rate of return. And these funds usually go through about a 10-year cycle. They look for things to go about 10-year cycle before they actually pay out. The ventures that have seed money. So that means they're looking for startups to help them get up and running. And when you get this money, this investment comes at a price. These folks, they're going to get in part of your business. And once they get in it and stuff, if they get in it and they figure out or they determine that you're not doing what you're supposed to do, or they don't believe you're doing what you're supposed to do, then they may take over your business. Remember, this is about making money. It's not personal. Uh, a lot of times it's not possible for seeding money with sometimes with the new startups or the one that's most risky. I mean, they'll do some, but not possible for seed, for seed funding when you have certain types of businesses that are determined to be somewhat risky. The history and future of venture capital. So historically, back on this, and it goes back into the 20th century, we look at wealthy families. You think about the Rockefellers, the Kennedys, Carnegie, folks like that when it comes to that type of money. And so, and as a result, what we find is we have this organization that was formed called the American Research and Development. And that was created in 1946 by a Harvard professor. And today, this is an organization where it's probably valued at about $355 million. And that was actually $355 million in December of 1968. So this is something that is still in existence today and is still funding. And the ARD is investment in digital equipment company. So this is that was also founded to help small businesses. And you see the Small Business Act. This was an act that was passed to help small businesses get financing to start their businesses. The dot-com bubble. The dot-com bubble, when this happened, it was unbelievable, the type of money. And this is primarily in Silicon Valley, the type of money that they were making. And everything was dot-com this, dot-com that, dot-com that. Well, the dot-com crazy lasted. And then it finally crashed. And when it crashed, all of those huge profits were lost. And so venture capitalists took a beating on some of those. Some people who maybe cashed out early did all right, but a lot of people lost a lot of money based on those. In 2008, we had a worldwide financial crisis that was led by financial institutions making shady loans and shaky loans and stuff. This set back a lot of venture capitalists, and it has affected not only the United States, but the world. And it hurt and it messed things up for a good while. When this happened in 2008, realistically, things stayed crazy to about 2010 before they started to settle down. And what you find with these venture capitalists and stuff, they will invest in heavy in certain types of industries and type of stuff. And I'll give you an example like business to business, business to customer, energy, finance, healthcare, IT. Those are the kind of areas where they look to make those types of investments. How venture capital works. So specific investment portfolios, small, talented, well-respected people, goals align with theirs. So when they're looking for specific investment portfolios, so they know the types of businesses they want to invest in. And when they see the type of business they want to invest in, the next thing they look for is who's running this business. They want to see smart, talented, well-respected people. Why? Because they know it gives them the higher rate. It gives that business a higher chance for success, which means they have a higher success rate for them getting returns on their investments. And another thing they look at to see, are these businesses' goals aligned with theirs? If they are, then that means, you know what, this is a business that I can consider investing in. And if they're not, that's another reason for them to say, you know what, I like your the type of investment you're making. I think you got good people here, but your goals are not aligned with mine. And so they'll walk away. So how venture capitalists works. So when they look at a team, this is what they would rather see. They would rather see an A team with a B idea versus a B team with an A idea. So what they're saying is basically this: if you give me an A team, a top performing group of people, and a decent idea, there's a high probability that they can make it work. But if you give me a all right team with a great idea, there's a high probability that may not succeed because they don't have what it takes to make it happen. So that's what they look for. They look for who is that team. Is it an A team or B team with that idea? Finding the right venture capitalists and stuff, you have to make sure when you are as an entrepreneur, the type of business you're in, find the type of the venture capitalist that might be interested in that line of work or that type of business that you are. For instance, if you're starting a tech operation, find venture capitalists who specialize in tech. not venture capitalists who specializes in retail. Why they might say no? They might say no because you didn't sell them. Remember, venture capitalists are looking for the best deals out there. So it's never personal with them. So if they're looking at 15 deals and they're willing to accept, and they only take 5, that means there were only 5 of them that actually sold them on why they should do it. The other 10, there were things that they viewed as negative and they walked away. What about a bank loan? Debt financing. You can borrow money to start a startup operation. However, do understand that most banks usually don't do that because they view startups as risky. And very seldom will they do that. And if they do it, they're going to ask for, say for instance, if you want to start up a business and you need $200,000. The bank may say, you know what? We'll give you a loan for $200,000, but we need to see your collateral and capital. What's your credit like, and what kind of collateral do you have? Basically, they make something and say, okay, you have a house that's worth $400,000. Okay, we're going to put a lien on your house for $200,000. So if this deal goes bad, we can get our money out of your house. So when we look at due diligence process to evaluate investment. So when it comes to doing the due diligence, this is when basically the vetting process of a business. Let me evaluate this business and see, is this a good opportunity? Is it sound? When you find this is what banks will do, their due diligence, and they could be long and slow by. This could take several, and with some type of investors, this could take several weeks to several months. Angel investors are less involved in this because they're looking at the time it takes to, they're looking for quick turnarounds and quick investments and quick turnaround on their money usually. So they're less inclined to go to deal with a business that requires all of that type of due diligence. Early stage. So when we look at the due diligence for venture capitalists, early stage investing is very risky. They all know that. So what they're going to do is they want to see a vigorous appraisal of the business. Is this business sound? Is it a good idea? Is it a good concept? And not only is this business sound, we need to see the people who are running this business. We need their backgrounds checked. Verify about them. Do we have anybody in here that's shady? Anybody's got skeletons in their closet? Something that can be embarrassment, that could cause problems within this business to the reputation. A business reputation is how it makes it. So they're going to do all of that stuff before they give up their hard-earned money. Venture capitalists expect a return. So they're not in it to become a long-term partner. They're expecting a return, and they're usually looking for that term within 5 to 10 years. So for some people, you might consider that's a long term. For them, they consider it short term because they can have some that could be longer. But this is how they make their money. Money paid through exit strategies. So you look at how money's paid. You look at one of the ways is through an IPO, initial public offering, acquiring different businesses. Buyback gives opportunity for the entrepreneur to buy back capital, venture capital stock at a premium price. Remember, they're in it for the money. And getting through the due diligence. This is something where it's going to take a while. It's going to be long. It's going to be a difficult process. Some businesses don't make it through there. And getting through that is going to be very essential to building trust for the organization so that people will be willing to put their money into it and not think it's too shady. Richer ruler, the trade-offs, giving up more equity. Okay, so when you look at this business, any investment comes at a price, risk of losing CEO position. Anytime you do this due diligence with these type of investors and you're giving up more equity, you're like, well, I'm giving up more equity and we're bringing in more money. But, that can be good or it can be bad. And understand that comes with a price. That means now, if you give up too much equity in hopes of bringing in the money, well, guess what? You may risk actually losing your position as the CEO or the owner of that business. Because now, let's say, for instance, you own 49% of the business, but the venture capitalists owe 51%, and they don't like what you're doing. they can vote you out, remove you. That's what would be referred to as like a hostile takeover. Startups may not have resources. Some of the things when you look at investors, when they carry out due diligence, startups may not have much resources. Resources mean people with different skill sets, the people it takes to get the things done, the types of equipment that you need. All those could be issues. One of the things too is when you look at sometimes with someone who's over the business, trying to maximize control over the wealth. You have to understand when you try to maximize control over the wealth, you have to make sure that you have somebody in place that can actually handle these things. But when you're trying to do that, if that's not your area of expertise and stuff, that can be a problem. And you have to also realize too, few make money and keep control. You know, for somebody who's got to start up and got these venture capitalists coming in, to be able to make the money that you want to make and then stay in control of everything is usually not the case. It's one or the other. You got to figure out, what are you in the business for? That concludes this chapter, chapter 13.